Is Las Vegas Sands a hidden gem hiding in plain sight? Or is it a financial disaster just waiting to happen? Welcome to today's Explainer. We're going to unpack a massive 21 model valuation of one of the world's most famous casino operators. We're looking strictly at the numbers, the balance sheet, and the competitive landscape to answer this burning question. With the stock currently sitting at just over $46 a share, is it a massive value trap or a legendary fat pitch? Get ready because we're diving deep into the data. Okay, I want you to just let this staggering number sink in for a second. 1,703.90%. That right there is the current debt-to-equity ratio of Las Vegas Sands. We are talking about a world-class casino giant carrying a balance sheet that honestly looks pretty terrifying on the surface. But this sets up the central mystery for our explainer today. Why do a mountain of complex financial models still claim this stock is actually deeply undervalued? So to solve that mystery, here is our roadmap. First, we'll run the valuation gauntlet. Second, we'll look at the media blackout flags. Third, we'll put it through the legendary investor test. And finally, we'll evaluate the moat and give our final verdict. All right, let's dive right into Section 1, the valuation gauntlet, where we're synthesizing 21 distinct valuation models. Now notice how bringing together these massive model groups actually reveals a pretty clear consensus. When we run standard discounted cash flow models, factoring in an 8 to 10% cost of capital hurdle, the implied value sits somewhere between $52 and $75. Comparables and multiples, looking at peers like Wynn and MGM, they point to $48 to $70. And then the advanced real options, which factor in that massive Singapore expansion, push that even higher to between $60 and $85. So what are the outliers dragging the average down? Well, it's really just the ultra-conservative dividend and income models, sitting way down at $17 to $38. Those basically just look at the $1.20 dividend and frankly completely ignore the company's broader growth profile. So the crucial takeaway here is this. When we blend the average intrinsic value across literally all 21 of these models, it comes out to a fair value of $55 to $60 per share. And with the stock currently trading at $46.23, the data suggests Las Vegas Sands is actually heavily undervalued. We're talking by about 15 to 25%. The models are basically screaming buy, but as we all know, models aren't the whole story, right? Which brings us to Section 2, the media blackout flags, where we're pitting the red flags directly against the green ones. First up, let's contrast the terrifying extreme of $15.28 billion in debt against their absolute world-class 79.8% gross margins. Now, yes, the company is levered enough to make any banker sweat, and that is a massive red flag. No way around it. However, management clearly believes the stock is just way too cheap right now. They're actually using those incredible margins to aggressively fund buybacks at these depressed prices. They've already reduced their outstanding shares from 716 million down to roughly 675 million. And this brilliantly illustrates the geographical divide of the entire company. On the red side, you've got shrinking revenue and a totally stalled recovery in Macao, where quarterly revenue growth actually dipped into the negative, down 0.70%. But then on the green side, you have this booming, high return on invested capital expansion happening right now at Marina Bay Sands in Singapore. The media just loves to highlight Singapore's record cash profits, but they kind of gloss over Macao's aggregate revenue decline. Now, if we look at the balance sheet, pandemic losses completely obliterated the company's book value down to just 90 cents a share. And their current ratio is exactly 1.0, which means their current assets are just barely scraping by to cover current liabilities. Working capital is incredibly tight right now. Yet despite all this liquidity pressure, management confidently reinstated a $1.2 annual dividend. That actually gives this otherwise low volatility stock a really nice defensive 2.6% yield. Furthermore, you might sue this incredible 123% return on equity on your financial screeners. Well, spoiler alert, it's a mathematical illusion. It's caused by the fact that their equity base is near zero right now. Add to that a weak free cash flow conversion rate of just 47%, mostly because heavy interest payments are just eating up the cash. But let's balance that red flag against the green ones. We're actually seeing director-level insider buying at those $45 to $50 levels. Plus, the company has massive net operating losses, NOLs, left over from the pandemic, which are acting as a massive tax shield for future profits. Moving right along to Section 3, the legendary investor test. We're grounding the math with Graham, Lynch, and Buffett.
First up, we have the father of value investing himself, Ben Graham. And honestly, he would run far away from Las Vegas Sands. The stock straight up fails his strict price to earnings test, since it's trading at nearly 18 times trailing earnings. But the real deal breaker for Graham is that balance sheet. He loved tangible assets, and he would completely reject the massive gap between a 90-cent tangible book value and a $46 stock price. If you run his strict formula, the Graham number for this stock is a dismal $7.23. So for a pure Graham value investor, it's a complete non-starter.
So what about Peter Lynch, the legendary growth at a reasonable price investor? Well, he rejects it too. Lynch usually looks for companies growing at 15 to 20% to justify their multiples. And the 5 to 8% growth profile expected for Las Vegas Sands outside of Singapore, it's just way too sluggish to justify paying an 18x earnings multiple. Their PEG ratio, which, remember, measures price against expected growth, comes in well over 2. That completely fails Lynch's test of keeping it under 1.5.
Then we come to Warren Buffett, the king of finding quality at a fair price. But before we get too excited, we absolutely have to acknowledge the $15.28 billion elephant in the room that creates some serious execution risk here. As Buffett famously warned, you should be very careful about buying a business with a lot of debt. But here is the crazy part. Despite that strict warning on debt, Warren Buffett might actually be the one to consider buying Las Vegas Sands. Why? Just look at this massive equity risk premium. The company is generating an 8.7% owner's earnings yield right now. When you compare that against a 10-year treasury sitting around 4%, LVS offers a really attractive premium of nearly 4.7%. You combine that with a return on invested capital that's consistently above 25%, and yeah, Buffett would almost certainly be intrigued.
And finally, Section 4, Moat and Final Verdict. Time to evaluate their competitive durability.
So, Las Vegas Sands actually possesses what Morningstar classifies as a wide economic moat. Let's break that down. Those highly coveted government-granted gaming licenses in Macao and Singapore, they are essentially untouchable intangibles. They're basically monopolies protected from any new competitors. The company also benefits from really high switching costs because high-end premium players develop intense loyalty to these specific properties. And of course, they operate with efficient scale as one of the largest integrated resort operators on the entire planet.
But, and this is a big but, we have to emphasize the immense geographic concentration risk here. They literally only operate in 2 markets. Macau is acting as a heavy anchor dragging against the stock right now, fighting massive structural headwinds like China's economic slowdown and the hangover from the VIP junket ban. Meanwhile, Singapore is the sole growth catalyst. It's the only thing expanding the company's moat locally and driving the upside.
So we're ultimately left with this massive paradox. Synthesizing everything from the sources we've looked at today, Las Vegas Sands is undeniably a high-quality franchise, and it's trading at a 20% discount to its fair value. But it is heavily burdened by a fragile balance sheet where any sudden revenue shock in Macau could immediately trigger a liquidity crisis. Basically, the models scream buy, but the balance sheet screams proceed with extreme caution. Which leaves us with this final, provocative thought. Is Las Vegas Sands a classic Buffett's that pitch trading at a massive discount? Or is it just a debt-laden value trap slowly sinking in a stalled Chinese economy? As always, remember to do your own homework and dive into these numbers yourselves. Let me know what your final verdict is down in the comments, and I will see you in the next explainer.